Okay, welcome everyone. We'll start our lesson two. Today lesson will go through LO2. As you know me, my name is Anjum Sathar. Please, if you have any question, drop me email anjum@ukversity.co.uk and I'll try my best to get back to you as soon as possible. During our lesson one, we discussed about four types of financial statement we prepare in accounts. We had a discussion about statement of comprehensive income, statement of financial position, statement of cash flow, and we discuss about these are financial statement we prepare. We had a discussion about cash flow. We had a discussion about creative accounting, and we quoted example of Enron, how they manipulate the accounts. Welcome, Asad. Thanks for joining.
Thank you. Thank you, Mr. Anjum. Mr. Anjum, I would appreciate one thing. Is it possible to make it full screen or?
Yes, sure. Why not?
Yeah.
Definitely. So is it better?
Uh,
Is it better now?
Same.
Can you see now?
No, it's the same. It's showing this. Now it's better. Now it's better.
Right. So welcome. We'll start. Any question regarding last lesson, please, if you want.
Uh, no, because frankly speaking, I understand majority of those things because I'm from finance. Other parts, some I don't understand. I will ask those things if I don't understand from you. Uh, but what I'll do is today I'll go through if we have the assignment available, the guideline for assignment. Then from that perspective, I will start asking about the questions,
Because we'll finish our delivery side and we'll do assignment discussion. In the meanwhile, I'll try to send you some sample stuff to
Yeah,
look.
sure. Ali
So
will join us
uh,
today.
yes, I drop message to everyone. Hope so Ali will join us. Okay, welcome. We'll start. Thanks for joining. Okay, today lesson key or command verb evaluate, interpret, and assess, and conduct. Conduct means carry on, assess means reason, judgment, and interpret the information like financial ratios that will help you looking the performance. And when we say evaluate, it's a qualitative judgment as we had a command verb during last lesson. Okay, so today lesson really we will discuss about the financial statement, publish accounts. We look the purpose and provide the information stakeholders, comparative analysis year by year, and we'll go through the benchmark why is important to look around, and the ratio analysis, liquidity, profitability, efficiency, capital, and invested ratio. And 2.1 is interpret the financial information to assess the viability of an organization. Financial statement itself has a limited use, but we need to look around the interpret the financial information and how effectively we can use. We can look around what the rivalry, competitors, and their ratios and the fund. And this is one of examples, which we can quote. For example, if you are identify the business that made the profit of 1 million, what does this word tell you? Because the 1 million profit, it can be your credit sales is a profit. Sales minus cost of sales equal to gross profit minus overhead expenses. We can say profit before tax, and then after tax, we can find the profit. So the profit is, if we have, if the year made the profit of 50 million and their closest rival earn profit of 60 million. So 60 million is the better, but again, it depends. If you have a cash profit, if you have a credit profit, because, buy now and pay in few years time, maybe all the bad debts, will happen. So that's why is really we need to look around those factors. We also look around the economic, social, and technological factors. What are maybe this last year profit was good, but this year technology change, legislation change, political, um, the stability in the countries, and many other factors. Those can impact. Like the conflict between countries and in the region. So we interpret the financial statement is important account and the information and the stakeholders, because like investor is very interested in term of they have the company has the ability to pay back. Lenders, they looking the company is looking the credit score, they will pay us back what their previous trend. Management want to be look around the trend and measure their success. We can look around various financial institution and the government really HMRC want the taxes we are paying accordingly or not. Okay, the ratio is financial ratios is all about the measure the financial performance. Ratio is basically the relationship between two numbers. That's which we'll carry on using. That's quite good to look around.
Training us, and I'll get back to this few minutes. Who? What? No. Lutfi, everything Lutfi. I'm dealing with you. I just show you. Lutfi is going to
mute? Ali, can you mute, please?
Okay, sorry. So let's please, we can look around. Thanks for joining, Ali. Welcome. Okay, so we're looking at the financial ratio. Ratios help to measure the performance. Ratios, the relationship between two numbers. Those are quite good, which we can use, and that's quite crucial to use. Okay, so 4 categories of ratios really. We can look around the liquidity, profitability, financial position, and use of resources, also known as efficiency ratio. So when we're looking the liquidity, we can look around the current asset divided by current liability, which is in short-term asset, most liquid asset, the asset which we can convert into the cash. Current asset minus inventory divided by current liability. Quick ratio, because sometimes inventory is not easy to convert into the cash, can be outdated. That's why we look the most. So there is a benchmark 2 to 1, 2 pound worth of asset, 1 pound worth of liability. Always good, but it varies industry to industry. But average, most of analysts agree 2 pound of asset, 1 pound of liability is absolutely fine for the business. But the quick ratio, 1 pound worth of asset, 1 pound worth of liability, 1 to 1 is the benchmark. Is good. But again, you can look around within the industry. Interest cover ratio, how many times your profit is higher than the finance cost interest which we are paying. Finance cost mean interest. Gearing, if you drive in a high gear, it's a high risk. So we can say if a high liability you have, if your borrowing ratios is increased, then ultimately it can be high risk for the business. Then we can look around the profitability, return on capital employed. We can use these formulas. Profit from operation divided by total equity plus non-current liability. But non-current liability, you borrow money for the long-term period of time for the investment purpose, like a mortgage, like a leases, like a bond. Return on the total asset, profit from operation divided by total asset. Return on equity, we can find gross profit margin, gross profit divided by revenue. Revenue, turnover, or sales is the same thing. Expenses percentage against revenue, and we can look around. Use of resources or efficiency, inventory turnover days, how many days inventory being converted into finished goods, how many days we are holding inventory and selling the goods, trade receivable days, always quicker, which is 30 days, and tradable payable days should be longer. So we always have a safety net, which is the cash. Inventory in days, and the working capital cycle, inventory days, receivable days minus payable days. The look around working capital cycle, revenues divided by total asset, revenue total asset minus current liability, which will carry on comparing these ratios to measure the performance. So main objective of the financial statement, provide the economic decision. Use of these ratios help to make the decisions about, and we'll carry on. So we can look around the interpretation of these ratios. So each ratios, so we can look around, conduct the comparative analysis by using these ratios, which will use these ratios, and then we'll do the comparative analysis as one example. So these are all the formulas. I'll give you separate sheet. And because when we are interpreting, so what is showing this? profit after tax divided by equity. So this is showing the relationship between the profit and equity. So we can find it return on equity, how much return every share, is earning. So some company their return is more than others. So it's always good to be, we can carry on comparing. So the gross profit margin and all, which we can compare, always good to be compared 2 years at least, and compare with the industry averages, current asset divided by current liability, liquidity, uh, use of resources, or effectively we using by using these formulas. Okay, so I included the links for Marks and Spencer, and next we can look around their financial statement. But in our example, we look around one of the company, um, which will go through. I'll just let's we look. This one. We have two companies. One is called Anika, one is Papika. These are the two companies, and we're looking their performance. So then we have a merit criteria where we can measure the performance. So can you hear me okay? Any question until if you have, please you can ask. Huh? So here we're looking the gross profit margin of Anika is 45%. So we pick the figure from their income statement divided by their revenue figure I will call sale. So this is 45 and the Papika is 52%. So if we look the profitability ratios, Papika performance is better than Anika. So we should go for Papika to invest in. Then we look operating profit. So operating profit is 9% and Papika is 11%. So if we'll say difference between 45 and 9, so what is rest yours? So 36% your overhead expenses. As a manager, we need to be focused around to reduce our head expensive to increase our profit. So if we look here, if you do 52.5 minus 11.5, so 41 percent is your overhead expense. So the company Papika has more overhead expenses than Anika. So that's which we need to be look around. Gearing ratio, what is meant by gear is you're driving debt divided by debt plus equity. So that's 30.26% is the risk factor. High gear is mean high risk. High ratio mean high risk. So here is 71.06%. So if we look the debt to equity, just there are two formulas and this coming 15.2. So if I then if you look the interest cover ratios, the operating profit divided by is 11.6 time our profit is higher than our interest, which we are paying. So this Papika is only 3.1, and if we do the asset test ratio, which is mean liquid ratio, is 1.22, 1 pound and 22 pence of asset again, 1 pound of liability. But when we look the Papika is only 65 pence of asset against 1 pound worth of liability. So what do you think between Asad and Ali? What do you think? Which one will go ahead to invest if you've been given the Anikas and Papikas, you've been given the profitability ratios, you've been given the gearing ratio is the risk factor, and a liquidity ratio. So which one you think, which company will invest?
Operationally, the first company I feel is much more, stable, because although the ratios are lower, there are other factors that can help, maybe it's which stage of the growth is this company is in. But if you look at generally, I mean, from a Papika point of view, it will generate more operational cash flow because it has good profit margin, but it is leveraged. So it's much more leveraged than Anika. This we have to be very much mindful of. Anything that happens with the interest rates going up and down will affect the profitability. But given that today's environment, we already know the profit rates are high. So I will go with Papika right now, although it's highly leveraged, but it's producing enough money to cover,
Okay.
leverage.
Okay, Ali, what do you think? Which one you want to go finally?
I think Anika is more. I will preferably to go to Anika, although they have a lower sale. I'm like in terms of capital gain, but at the end, still they're making quite good numbers of profit,
Hmm. So if we
margin
look,
profit.
yeah, so if we look here, Anika and Papika difference is 7%, yes,
Yeah.
around. So
Mm.
if you look the risk factor is 13% the risk in Anika, but Papika is 71% risk. Yes,
Yeah.
high risk. So if we look the interest cover ratio is 11.6% and other is only 3%. If we look the liquidity is Anika is better than Papika. So in overall, if we look the profit difference and the risk difference, Anika is miles better to be invest compared to Papika. If you're a high risk taker and think about the company not going to liquidate, are you thinking their future plan is quite good and industry average is increasing, then maybe you can consider the Papika, but Anika overall is better to be invest instead of Papika. Yes. So not looking just only but the profitability is mean can be credit sales as well. Yes. But the risk factor is a high in Papika compared to Anika. So we can look around. Anika is better overall. So we can invest in Anika if you're not because high risk, high return. So it's a 7% high return, but the risk is very high. So that's why we'll go for Anika. So these ratios, investor determine to buy or hold. A potential investor can determine whether to determine the shares. Lenders can be determined either give them borrow money or which interest rate. Customer really need to be if you're getting the guarantees, warranties, the company can, and the government really want to look around the tax public really interested in the contribution to the local economy. So every stakeholder have different interests. So those we can look around. So as 2.2M, we can look around in gearing. Uh, Gross profit is better, operating profit is better, but Anika's gearing ratio, interest cover ratio, acid test ratio, and overall, we reach the conclusion of Anika is still preferable to Papika. But we don't rely on these ratios only. We can look around the PES. What is the PES stand for? Political, economic, social, and technological factors, not just. So not really the matter of we can. So we need to be look around more investing in Anika, we look the political stability, we look the economic factors, we look around the growth rate, we can look around per capita income, we can look around the GDP, we can look around transparency in tertiary reports. We look around the society, young population to whom we are selling the fashion, and we look around the technological change like AI, artificial intelligence, all. Okay, then we have 2.D, the distinction criteria, limitation of this ratio. Financial statement may be several months out of the date. Financial statement include the information can be made in the monetary terms such as the intangible asset, human reputation and all. Comparison the business by misleading the different accounting policies, creative accounting, if you do the costing like inventory, last in, first out, first in, first out, or FCO inventory evaluation, your closing inventory value can be different. Effect of the size and the ratio may not always be calculated accounting to the same formula, and the ratios may be based on just based on the formulas and the estimate. So that's we have these all the problem which we need to be look around. Any question? Anyone here, please? Any question until now?
So in sense, what we are saying is we are looking at the internal company books also, And by past analysis, we are looking at the external environment also, right?
So we look the external factor, and so we look at external factors like political stabilities. We can look around the trend, the taste, and the fashions and technologies and all. Because the ratios maybe give you the figures, but what is happening now, like COVID-19 lockdown, everything, yes? So we need to be look around. We need to look around these, the factors before we decide, finally to make the decision either we'll go ahead or not. Any question here? So, like at the moment, base rate in the UK is we discussed in the yesterday lesson. It used to be 5.25%, but it's dropped down to 5%. So this is indicator the cost will come down. So ultimately the profit can go up even. If we'll just look the ratio, maybe the ratio not look good, but in future the profit can go up. Yes, so these are the factors we need to be look around. Any question?
Okay, great.
Okay. So today lesson really we look around and we went through the ratios. So profitability, liquidity, use of resources, and gearing ratios. So always looking the performance and ratios, financial ratios we use to interpret the performance of the company, and the facts and figures we can find from the financial statement, and we can prepare the ratios. Nowadays, of course, if you go on the Yahoo Finance or the Google Finance, you can find the FTSE index data, and you can look around any company of your choice. Those are listed in the stock exchange, depend which country or which stock exchange you're looking, and you can normally the ratios prepared, and you can look around. In only the thing you have to do as an analyst, you have to interpret according to your own situation, and then you can make the future decision based on. Yes, that's all. So today lesson we discuss these factors. Okay, so next week, next lesson we'll go through LO3. Next our Saturday. Please, in between, if you have any question, you can drop me email. The sample assignment, I'll send you some resources available. So our learning outcome 1 and learning outcome 2, and we'll go through separate assignment discussion lesson after, when we'll complete the delivery side. So then I'll give you all the resources, and I'll give you the tools how we can, and go through the Harvard reference and the table of contents, how we can create, how we can structure as well. So we'll do the lessons on this, just assignment discussion. Okay, so in between is good to be look around the key points within our unit, look around our LO3, and the next lesson will go through LO3 learning outcome 3. Okay, so that's all from my end. Any question before we finish? Ali, yes, sir. Any question?
Yeah, I'm okay. I'm fine. But this last item, last slide that we have, the limitation slide, okay?
Yes.
These are like telling us these are the risks that we can face, limitations in this.
So
So
we
I
rely 100% on our financial statement, our financial ratios. Yeah.
so let's say we find a situation where we have these limitations. So it's better to drop that comparison.
Yeah. So you look the current economics environment, current company position, and their future plan. Don't 100% rely on the ratios itself. You use the ratios, but you use the what is happening in the current economies as well, and then you can read the final decisions. Because
Great.
creative accountant can manipulate the figures, like yesterday we discussed about Enron.
Yeah.
Okay, that's why the figures maybe. I can say, Asad, I'll sell you the things on credit. Yes, no problem. You can pay me in 5 years. Yes. So my sales went up. My ratios look good. What is happening? My cash. Yes. What is happening future? maybe the company will liquidate your industry is going down, or the things become outdated. Yes, maybe the out of technology. Yes, new technology arrive in the market.
Yeah, I mean, if you go back to the ratios,
Hmm.
the one ratio you talked about, the working capital cycle, you
Hmm.
know, uh, we take the case of Anika and this both, and if our working capital cycle is negative, even though you're profitable, you will be out of business, you know.
Yeah, because you're right. Because end of the day, you don't have a cash into
You're
in the.
not collecting your money, but you are very good in profitability.
Hmm.
So, I mean, we have to look at combination of different things while comparing the
Yes,
companies.
you're right. So we can look around inventory turnover days, receivable days, and payable days. Yeah, because you have a safety net. If you don't have a safety net, you can't sustain. You're right.
Because if you're negative with every cycle, you are going more into the negative.
Yes, you're right. Absolutely right. Well done. Good interpretation. Yeah. So that's why you focus on your credit control policy of the company. Yes.
Yeah.
So you need to be make sure give the credit to those they can afford it. They pay you within 30 days, and you pay your supplier within 90 days. So 60 days you always have a safety net. Yes.
Great, I'm done. Thank you. Thank you very much.
Thank you. Great. Okay, well done. Thanks for attending and have a lovely weekend. A bit left your end, and hope we'll speak you all on next Saturday. And enjoy. Speak
Thank
you.
you. Bye.
Thank you.
Thank you.